Whoop, let's go. It's time. Woo! It's time. AfroEconomics Live. Started about 30 minutes early. Somebody got mad. That's all right. Got to get the party started early. Yes. It is a beautiful, beautiful, beautiful night. It's Wednesday night. AfroEconomics Live. Come on. I better stop playing before they get me with all these different violations. Stop my video. Can't even play the music. I tell you. That's okay. We got a little bit. It is time. It is time for us to enjoy our evening talking about some exciting financial information. You know it. When you woke up this morning, you were like, I can't wait to talk to JB Bryan tonight about bonds. About bonds. We got our members in the studio, Star and Weta in the house. That's amazing. The way that the chat's coming up tonight. Look, this thing does whatever it wants to do. But I can see your picture. I can see Michael's picture. That's right, Star. Whoop, whoop. How you go, whoop, whoop? Is that it? That's it, whoop, whoop. Uh-oh, I see you. The Frank, look, I can see Frank, but I can't see. Like it's not strolling. Y'all see that? Like the logo's up there. I'm gonna try to turn the chat off and on so you all can ask me questions and see if it'll present a little differently. It's not. So I'm hoping that it just kind of gets itself together. Cause Mr. Fleming, you might have said something, but all I can see is you and your grandson. So true. Look at him looking adorable. So we're talking about bonds because I just thought that it was time to talk about bonds. I talk about the stock market a lot, and you don't think I don't even know why I never think about the fact that, as a lot of my portfolios have bonds in them also.
Should be
right. So then I got I said so we're getting in it. So I said what I would do is make sure we had a discussion about bonds because a couple of weeks, like I've had especially Mr. Wen, what's his name, Kenneth Wen. Where are you, Kenneth? I know you're probably trying to say something, but the little connection to you is not working. I keep trying to do that reset on it. Oh, you know what? I can try. I'm just gonna pull up on my other computer here. I got a little terminal up in here, and then I might be able to see at least on YouTube. And then when I think about it, I might go back and check on y'all. And the let's look. I'm gonna go to the channel because you're probably making saying something, Mr. Fleming, and then I can't see it. So I'm gonna try to go this way. If I click into it, and then I'm going to I don't know. I can't pause it. I have to turn it down. So I'm going to turn off the sound. Let's try that. I see you. How you doing, Miss Hooker? I can't see that comment in the other side. But I can see you now. Hi, Miss Hooker. Hi, Michael. Hi, West East. Yes, indeed. AfroEconomics about the bonds. How you doing, Miss Davis? Stone Mountain, Georgia. Mr. Fleming, what's up? What's happening to you? Oh, thank you. Indeed. So let's talk about bonds. I'm going to make an effort to make what's really a very boring topic. Let's try to make it, because of your interaction, more exciting. I wish that Weta wasn't working, that she wouldn't have all that technology going. And because you are the mistress of asking questions. but I'm gonna put you in timeout. So Star, you're gonna have to come up with some good questions, some really good questions to help me along. I know, Weeda. I don't know why you're getting put everything on mute, Weeda. Put everything on mute. So let's go to mine. I wanted to talk about the new bonds. bonds, and they're really inflation connected government bonds, and they call them bonds. Sometimes you'll call them inflation protected. You cannot call me, your broker, and purchase the bonds the same way that you can purchase them from the government. They want you to go to treasurydirect.gov if you want to buy their bonds, or you call me and I put you in investments that have the bonds in them. So we can do like an bond ETF, things like that. So what is a bond? So you have all different types of bonds, but bonds are not ownership. Bonds are when the government or a corporation or a local or federal government wants to raise money. And they want to get some money, but they don't want to give you ownership to their company. So they don't use stocks. See, stocks are pieces of ownership of the company. How about that? Right, T? Y'all are all up in y'all are all up in the studio. That's right. The bonds. Look, I saw she had on the camera and then turned that camera right off. So the bonds, there's different types of bonds. So the bonds, government, corporate are the major areas, and then there's different types of corporate bonds, and you might have global bonds, some international bonds, but they're all about lending money. You are the lender. And they are paying you out interest. So then I remember in the inflation protected new bonds that I is for inflation. But in bonds, there's some major areas of bonds that I want you to know about. All right, there's bonds, you're receiving interest. So you're receiving interest, and that is the coupon payment. And then in bonds, you have a face value. And the face value is what you will receive at maturity. So you might purchase a bond that is a 20-year maturity or a 10-year maturity or a 30-year maturity, or it might mature in 5 years, and you can see the face value, but that face value may not be the market value that it is, or the issue price may not be the face value or the value that it will be at maturity. So sometimes the issue price, like when I first started, zero coupon bonds were real popular. So their issue price was approximately half of what their face value was. It paid out no interest, so it was called zero coupon. But at the end, you would receive that face value that was twice as much. So you put in 10,000, you get 20,000 at your maturity date. So, but with the regular inflation protected bonds, you're receiving the issue price for the bond, and then they're promising you an interest payment, which is your coupon payment. And the interesting thing about bonds is that some of them have a fixed coupon payment, and some of them have a floating coupon payment that works like adjustable mortgages. Or more adjustable mortgages can be adjusted. And then, so let's talk about bonds. Let's talk about like the risk and bonds. and I'm gonna see if you'll talk to me, Sky. I'm Star. I said Sky. Do people ever do that? Call you Sky? So like that's not my name. My name is Stars in the Sky.
Sky.
So when you think about bonds, you really don't think of them as being risky, correct?
No, I kind of think of them like a sort of like a CD.
Yeah, because they have that coupon payment. CDs have interest payments.
Mm-hmm.
CDs will pay like once a year. Bonds pay twice a year, typically. I don't know. There'll be one out there and it'll pay 4 times a year, and somebody will say, such and such pays 4 times a year, but your typical is twice a year. And the interesting thing about these inflation protected bonds is that the government is marketing the interest rate, but that interest rate that they're telling you is really the annual rate, but they're only going to pay it for 6 months. So you're only getting half of that rate. And in 6 months, it could be lower or it could be higher. But they always quote the annual interest rate. I think that's kind of misleading. Because if it goes down, if inflation goes down, but inflation numbers were up in March. So when it adjusts in May, the interest rates should go up. So when interest rates go up, if you already own bonds, then your value of that market value of that bond will actually go down. So the issue price for a new person will have to be lower than it was for you because they're getting a lower interest payment than the current interest payment that's out there. So bonds actually have an inverse relationship with interest rates. If interest rates go up, bond values go down. And if interest rates go down and they say, well, okay, we're not going to increase interest rates like the Federal Reserve says, we're going to keep everything down, and interest rate starts going down. Now, inflation protected bonds are different because they're not connected to interest rate. They're connected to what? Inflation. So when the government gives us the estimate of inflation, that's the payment that the government is to pay for their inflation protected bonds. And these are the highest interest rates ever in history. So I know they're like, whose idea was it to come out with this product? Because inflation was so low for so long that they came out with the idea, it's like, so they have a maximum amount that you actually can invest directly into the Treasury Direct, those inflation protected bonds. There's a maximum of $20,000. $10,000 or $20,000 per household. So, you have to decide, like, is it worth your while to have an additional account to have to keep up with, and do you need the money anytime soon? Because it's not like when you buy a bond from me or get a bond ETF from me, we can trade it anytime we want. And those I bonds issued by the government, you have to keep them for at least a year. And then if you sell them after a year, at 1 year and 10 days, you still sacrifice 3 months of interest. Isn't that interesting? And the only way to get the full interest rates is to keep it for 5 years. So it's really, they should call it 5-year lock-in, but it's not. If you really want to get everything that that you're expecting. But the fine print on things is just important. I just think that that's amazing that the government has a product that has that many different criteria to it. Like this, and then 6 months, and then it floats, and then it this, and then you after a year, and so you have to, when you go to treasurydirect.gov, read all the details if you put your money in there. No surprises. Or call me, join AfroEconomics, talk to your financial advisor. That's what I do with the members of AfroEconomics, help them build wealth.
So you actually have to jump through hoops just to get that high interest rate. Whereas a CD is easier, but you'll get a lower.
Oh, yeah.
Yeah.
But there's a whole bunch of other bonds that you could do to do better than CDs. CDs don't have liquidity either because what? If you want it back, it what?
You lose something.
You get the penalty if you want it before their maturity date. But if you buy CDs through a brokerage account like a brokerage account with me, then you just trade it. But if interest rates go up, your market value for that CD will go down. So you don't have the bank penalties, but you're exposed to market changes. But there's so many different products out here now that many people who are conservative are not even considering, the options that they have as far as doing bonds and the different types of bonds that are out there. The government bonds, the typical government bond or a government bond ETF, exchange traded fund, or a government bond mutual fund, like you're investing in a stacking, hundreds of bonds with different maturity dates because there's so much money being accumulated. Or we can purchase the bonds individually. So mostly what we're talking about at this point is just understanding what bonds are. But many of you in your IRAs, your retirement plans, your 401ks, your TSPs, you have bonds in there, but you just don't understand exactly how bonds work. So now, like many bond funds are down. And people are confused because they're like, why are the bonds down? I thought just my stocks would be down. Why is this happening? But it's because as interest rates go up, bonds, the market value of your bonds are going down. So there is a difference between your bond yield and the actual coupon payment that you're receiving on the bond. So you're going to receive the coupon payment that they promised you as long as the credit risk of the issuer stands strong. So your coupon rate is connected to the government. The coupon rate is lower. Why is the government rate lower than XYZ Corporation's coupon rate or interest rate? Why does the corporation pay out more on their bond than the government pays on their bond? What do you think, Star? She's like, why you ask me?
What was the question?
I'm sorry. I know, you're right. I forgot to look at the chat because she's over there.
Yeah, I was looking at
You keep me in timeout. So Weeda, like just because you make noise sometimes. So my question, Weeda, is Weeda asking? She's like, Weeda, my question was, why do you think corporations have to pay a higher coupon rate than the government has to pay? Like, and when I say coupon rate, I'm referring to the interest rate they pay you. And Star, you can say your opinion as well. Why do you think, Weeda?
I have no idea.
Was one's paying the other?
Was one's paying more than the other?
Right.
Yes.
One.
The corporation.
One, because I think maybe one is paying more than the other one.
But the corporation typically pays more than the government. Why? And it's because of risk. The government is seen to be able to pay you back.
Let's say
how you have that big a delay? The government is seen as very stable. So because the government is so stable, unless the politicians close it down and they say, we're not paying any interest, then you're not going to get the, the government, you're not going to get the government to have to pay a higher interest rate as a corporation that is not the government, because the corporation has much less bill paying, which is called credit risk. Their credit risk. The credit risk for a corporation is so much higher than the government. Make sense? Because the government prints money. So they can pay us our coupon payment. So because of that, when you do government bonds, it will have a lower coupon payment or lower interest payment, but it will and it's so the government doesn't have to pay as much back to the person who's loaning the money. Because when we're buying government bonds, or you're doing the G fund in your job at the federal government, you are actually lending money to the government. That's how they, are raising money. So they don't have to pay you back as much as if you loan the money to a corporation that was using bonds to raise money. Bonds are a way of raising capital for businesses, for projects, for municipalities. Like when the city wants to build a new coliseum, they'll issue bonds. The city's interest rate will be higher than the federal government's interest rate, right? Because the city is seen as a higher risk than the government, than the federal government. So bonds, when it comes into play with bonds, it's knowing the credit. And I remember early in my career, I met this couple, and the couple had purchased corporate bonds, and the corporate bonds were designed to finance cars. And they were financing, it was a bonds that were being issued by a corporation. They were raising money, and they would take the money and then finance cars at high interest rates. It was for high interest rate people. And I told the couple, I said, this is totally inappropriate for your risk level. Y'all are in your 70s, and these are like D-rated bonds. Like, that is extremely risky. These are not. And I remember speaking with my supervisor at that time. That was before I started my own firm, and a big part of why I decided to start my own firm. And I told the boss, I said, they should never have been put in this. And basically, I was complaining about one of my coworkers because it was inappropriate, but they never took them out, and they ended up losing all their money in that bond. And and the only way for them to protect themselves is they would have had to really stand up for themselves. But I thank God that that someone that worked there in another department said, I think you need to talk to this new black girl. I was the only black person in there about, this, because I don't know what's going on, because the value of it kept going down, 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 down. And I was like, this is crazy. Like, this is inappropriate. I believe they should have gotten all their money back, but it was extremely low if they got any, but it wasn't my account. So, but we have to realize that all bonds are not created equal. And there are some bonds that are more aggressive, really, even though they're telling you, we promise you we'll pay you this interest. But the fact is, they might not be able to come up with that interest that they promised you. So be very careful in our bonds. Be very careful in understanding that our bonds are still bring some volatility to your portfolio in a volatile interest rate market, and that's really what we have. So I want to refer back to my notes. So I asked myself, how can a bond have a negative yield and a positive coupon rate? Because you'll look now, if you're looking up bond investments don't, or they might say that the yield, especially year to date, is a negative number. See, but the coupon rate is still whatever they promise to pay you out, 2.5%, 3%, whatever. You're still going to get that. But the yield includes the value of that 10,000 you put in may have gone down to 9,500. So the yield might be negative 11. Your total return, like it includes that. So you might have dropped in value by 10%, but the coupon is 2%. So it will still show you a negative approximate 8% at least. So that's how you can have a negative on your statement or negative on your value, something that you wouldn't see if you go to a bank and you buy a CD, right? And you buy the CD, and the interest rate for the CD was 4%. And new CDs come out and they're offering 4.5%. Who wants yours at 4%? So in order for you to get the yield to the purchaser, if you wanted to sell it, you would have to come down on your price. So if they spend $9,500 and get a 4% coupon, their yield will still be closer to that 4.5% of the new prices that are out there. And likewise, if it went opposite, if the interest rates went down and you to 3.5%, and you had a CD worth 4%, paying out 4%, you don't know this with a CD though, because they penalize you regardless, correct? But on bonds, you see on your statement, the market value can go up. Like so you can make that gain. You can make a capital gain on that bond that you own if the interest rates, go down and yours becomes in high demand. You can actually make a gain. Like you have this 4% at 10,000, and then the new ones come out at 3.5%, and then all of a sudden your 10,000 bond its market value is now 10,500 because of demand. So so that's something, you know what I mean? That is definitely something I want us to, make sure that we are completely, when we have our discussions, when we have our one-on-one time, that we look at that. That we just think about bonds. I include them a lot in my portfolios that I put together, especially if your goal is to reduce, like if your goal is to reduce volatility from the stock market, then I might give you some bond exposure, or because especially if we're using a risk analysis, and your risk analysis says that your risk score is 50 or 40, meaning you're not very aggressive. I can't have everything in equities. I'm going to have to give you some bond exposure in there, or you're going to have cash. So the goal is to try to still get you to beat inflation overall. The reason that we invest is because you're building assets and your goal is to outpace the cost of living, or at least keep up with it. So there's not a time that you're living where you don't need to make sure that you're outpacing inflation. So if you get to where it's like, I just want all my money in cash, the challenge there is what? What's the challenge? The challenge there is we like, she put me out again. Yes, because you were making noise. But the challenge throughout our lives, but especially once you have this pool, this big asset, is to make sure that we create an efficient portfolio. Like a client sent me, because a lot of I don't really realize it, that a lot of times you all get information from other brokers because they want to show that they can outperform, they can outdo, our account. So this client said, here's something that I got from this bank, and their financial advisor sent me. Can you send it to me? Can you review it for me so we can go over it? I love when you do that, because not that they were charging him way more in fees, but it also were over diversifying him, and it was putting way too much of his assets in bonds when he already had the bulk of his assets guaranteed. So it was really slowing him down, because he had like huge bonds, especially like, say, a person has guaranteed income. They already have guaranteed income, but they know that guaranteed income is not going to go up considerably. We have to be smart. Don't just invest in stuff that people just present in front of you. You need to make sure that they have a clear understanding of you holistically and where these bonds fit in. Because I feel that they had him way too overexposed in bonds. And then what that would do is what? Reduce his chances based on historical performance, based on history. Being overexposed to these bonds is reducing his chances of reaching the goals of outpacing inflation for the rest of his life and increasing his lifestyle. I see y'all. How you doing? I'm sorry, but I can't see all of your technical stuff. We just had that considered safe. Is the I bond considered safe? I see y'all on them. I'm trying to look at the YouTube to look directly. Also, this is also live on Facebook as well. But the comments are not coming up on the screen. I might as well close the overlay, because it is just it just did not work. It's reported to the Restream people, but I can't see you. So I'm looking over here because I was trying to see some of them, but then I can't. Oh, it was showing me what it should be showing me on here, and it's not showing it. That's weird. And it's not showing it on YouTube. How you doing, Miss Pritchett? I see that. So it might be when I was showing the caption that it was showing it from somewhere else. It might have shown it from Facebook. But I appreciate you all. And I will go back to each place and address if you have any questions and I'm not seeing it or addressing it in our discussion. Because the bonds are just new, but there's key things that I want us to make sure that we take. That face value is what you receive at maturity. Bonds, first of all, bonds are you loaning money to an entity. You are not getting ownership. So bonds versus stocks. Stocks are ownership, and stocks, the goal is for them to appreciate. And some stocks pay out dividends. With bonds, you are not owning it. You are just lending them money, and they've promised to pay you a coupon payment, usually paid 2 times a year. Bonds have a maturity date. The longer the maturity date, generally, the higher the interest rate that you're going to receive, usually. And then they have a issue price. That's what you pay to receive it. Then it can have a face value that is what you will receive at maturity. They don't, making sure, and that is to say, because remember that I was saying, sometimes the issue price might be $9,500, and the face value at maturity may be $10,000. But just know that the coupon rate that is paid, it could have it could float, it could be variable, it could change, like the inflation bonds that the government use, the inflation protected, they change every 6 months. The why did they do that? They do that to protect themselves because they want to be able to bring down interest rates if interest rates go down. And sometimes it works in your favor because rates could go up, like inflation is going up. So most likely they're going to have to increase the interest paid on inflation protected bonds. So bonds can be a great way to earn income, and they generally tend to be safe, but that doesn't mean that they're not volatile. Let's make sure we know that. There's risk involved. There's risk involved because bonds have a rating, and how strong the bond is based on the bond issuer's ability to pay the principal back to you and the interest, the coupon rate, the coupon payment that it promised you. And there's companies that actually rate bonds, and the ratings are published, and we use them for in my business in deciding the worthiness or the value or the riskiness of a particular bond investment. And we look at their rating. Also, there's interest rate risk in buying bonds. Interest rates have an inverse relationship. So when one goes up, the other goes down. That's inverse relationship with bonds. So when interest rates go up, then the value of the existing bond goes down. So there's that risk that's in there. And the greater or the longer the maturity, if it's a 10-year bond, then it's going to have a greater interest rate risk than a 5% bond. Because it's harder to predict 10 years than to predict or plan for 3 or 2 or 5, correct? And then there's also a prepayment risk. And you're like, well, why would that make a difference? Well, if the bond allows for the issuer to pay you back, that's going to happen because they don't want to pay you at the high interest rate that you have. So say you have this 4% bond, and then interest rates go down. They will refinance by issuing new bonds and then pay you off to get you out. So there is a prepayment risk. So you have to see, can this be prepaid? Can this corporation send me this money back? And does it have a call provision? Where they will call the bond in and say, give, and you have to take it. And they go, here. Interesting. It's kind of like that with Elon Musk. He took Twitter private. So all the people that had Twitter stock, I'm skipping to stocks for a second, but it's like that with a prepayment on a bond. It's like, he said to them, I'm going to buy this company. So everybody had to accept the price that the board approved. And that's what they'll get for their shares of Twitter. Goodbye. That's it. That's what they'll have to do if it has a call provision on a bond. But I just want to make sure that this week that we know that never assume that because it is a bond that this is, this is perfect. This will never go down. Oh, this is the guaranteed one. Like you could, especially like say in your work plan, and you choose to put everything into bonds because you think that bonds will never go down, and then interest rates go up, and then your bond, all the money that you have in bonds still goes down. And you are like, what is going on? I'm not in the stock market. No, you're not in the stock market, but your bond funds move in an inverse relationship with interest rates as well. So make sure you're getting the proper help. That's like one of the first things I like to do in the AfroEconomics membership is get your asset allocation correct. of your current investments that you have and help you get a better understanding of your portfolio. It's important. So does the I-bond have a call provision? The treasurydirect.gov would have to answer that. But I think the government can do whatever they want to do. So I'm sure that they have that in there. Look, if we decide that we do not want to do these anymore, we will send you your money back. Period. Yes, I would have. Look, I'm saying I don't know, but I'm sure. You're talking about the same people who you have to stay in it for a year. And then if you don't stay in for 5 years, they still take 3 months of your interest back. So yeah, there's some stuff there you need to understand. I would anticipate a call provision in there. If inflation keeps going up, they might just be close all of them down. Look, would it be something? But it's interesting to me is that seems like it's a conflict of interest that the same entity that's paying out the interest is deciding what the inflation rate is. Who gets to do that? That doesn't make sense. You determined what inflation is. It's like with Social Security though, too. It's like, so it's coming from your money that you sent to the government, and then the government tells you how much inflation is. But even though inflation is, according to the government, up 8.5%, the raise for Social Security was only 5%. So I don't know, how do you do that? Like, determine a number, but you don't make sure that it is actually acknowledged or used. There's a straight conflict of interest. They need to have a public consumer board that oversees stuff like that. Like just average people that are making sure that we know the inflation rate is actually the inflation rate, because I really think that it's higher than 8.5%. Like I'm not saying that out loud. There's a lot. There are some complications, and just make sure you understand all the fine print whenever you send or spend your money anywhere. I believe that the more we are mindful of our money and little things, because I hear way too often, people go, oh, I just sent them that. That's not okay. That's not okay. Like, every dime counts. So just be mindful of that. So then we got the risk, we got the ratings, we got the major factors of bonds. The how to invest in bonds. You might ask. I believe that treasurydirect.gov for those inflation protected, or talk with a licensed investment advisor like myself, and we open an account. It could be a brokerage account, regular. It could be a brokerage account. That's your IRA. But we open the investment account, and then we purchase the most appropriate investment portfolio for you. So we look at everything. But just remember that bonds are considered interest and fixed income category. You're receiving interest, so it's considered a fixed income. We talked a little bit about how bonds are valued based on the market changes of interest rates and the value, and what the difference between yield and your actual coupon rate. Totally different. So we look at those things. There's corporate bonds, there's government bonds, there's municipal bonds, there's global international bond funds, there's high yield, they're called some corporate bonds called high yield. bonds. There, sometimes you'll see it called debt investments because you're lending money to the corporation. So they are indebted to you, versus stocks are equity investments because you're purchasing ownership of the entity. With the bonds, you're lending the money and they promise to pay it back. Any
With
questions?
interest.
Mm-hmm.
With interest? You said they.
That's right. You lend them. You're lending them money, and they pay you back with interest.
But you keep making reference to coupon value.
Mm-hmm.
That's what we pay. That's the 10,000 that we pay.
No, you pay the issue price,
It's 10,000.
and then you receive a coupon payment, which is the interest.
Okay.
Those, I just bring that term up because if you hear it, I want you to have heard it before. They might say the coupon payment on that is blah blah blah, or the coupon rate is, but that's the same as the interest rate.
Interest rate. Okay.
And the great, and then the face value is what you receive at maturity, and the market value is what it is on any given day, because the value still can go up and down when it's in a brokerage account. Great questions. I'm sorry, y'all. I know I see you, and I appreciate you being out there with me, and I can't see your questions, but I appreciate you, and I will go look for any additional questions. Thank you to Jennifer Royal that was in the studio today, and also Chi in the studio today, and Mr. Dixon. How you doing, Mr. Dixon, in the studio today? They don't have their cameras on, but we appreciate you. Mr. Dixon, you working all the time, and I'm glad you took a moment to log in. Of all nights, you decided to log in, and we're leaving. We're leaving a little early. Any other night, I'd be like running off 9:15. Tonight, Mr. Dixon's like, I'm gonna get in before they finish, and then we're finished. But this will definitely be on all of our social media platforms. Please click like, please share, please ask me any questions. Remember, we have a complimentary free membership. So the free membership is available to you, and then you can participate in our members only stuff, and then get to know us, and then you can upgrade, and we can start doing financial planning together too. But definitely take advantage of the introductory free 30 days, so that and then you can upgrade from there. Have a wonderful time. My email is jb@jbbryan.com. Have a wonderful week, I should say. I appreciate your time. Thank you so much. Thank you, Wida. Thank you, Star. Thank you, Mr. Davis. Thank you, Chi. Thank you. Y'all have a wonderful week. Talk to you soon. It seems so quiet.
Good night.
Good night.
Thank you.
Thank you. I got you. Thank you, Miss Davis. Talk to y'all soon.